All right, so welcome to the first chapter of Introduction to Taxes. And really, before we can talk about the specifics of what's taxed and what's deductible and what's income and all of those types of things, we have to talk about some introductory things. And unfortunately, we have to define some vocabulary and make some distinctions kind of between the tax world and the world y'all are accustomed to of financial accounting. So let's get going. All right, so first of all, what qualifies as a tax? Lots of the things, payments that we make seem like they are taxes, but they might not be a tax in actuality. They might be a fee. Okay, so it's important to know the difference between what is in fact a tax and what is a fee. All right, so this slide talks about the definition of a tax. And there are a couple of things, and it's important to know that these are and qualifications, not or qualifications. All right, so a tax is a payment that's required by a government agency that is unrelated to any specific benefit or service received from that government agency. Okay, so that is the definition of a tax. So when we move to the next slide, we'll go through some examples of things that can either be a tax or a fee, and we'll talk about why each of those things is either a tax or a fee. All right, but before we do that, we need to talk kind of about taxes in general and kind of why are taxes such a big issue? Why is there a whole class, right, on taxes? And in fact, there's not just this one class on taxes. Then we have a follow-on class about business entities, and there's tax research, and there's all different types of taxes. And the reason for that is lots of people care about taxes, right? From a business perspective, okay, taxes are a real cash expense, okay? Depending on how that business is organized, that is going to in some way determine their tax liability. So from an organizational form perspective, so does a business choose to organize itself as a C corporation, or does it choose to organize itself as an LLC or a partnership, for example? All right, and we'll talk about some specifics related to different entities in chapter 15. All right, where is the business located? All right, that is a big determinant of taxes as well. So, for example, we live, most of y'all probably live in or around St. Louis. I live in Illinois, and so the tax situation in Missouri is very different than the tax situation in Illinois. And so depending on where you locate your business, you are going to be subjected to the taxes in that state. There are also local taxes, right? UMSL is a great example of an entity that made some wise tax choices. All right, so UMSL is not located in St. Louis City. UMSL is located in St. Louis County. And the reason that UMSL is not located in the city is because by locating outside of the city, UMSL is not subject to St. Louis city taxes. And as an UMSL employee, then, I am not subject to St. Louis city taxes. So where a business is located can very significantly determine a portion of their tax liability. Okay, businesses also have to think about how they acquire capital investments, how they acquire land, how they acquire buildings, assets of any kind. Do they use cash? Do they finance those things with debt? All of those have tax implications. Employees, right? Employees are expensive, not just from a salaries perspective, but what about a benefits perspective? And how do payroll taxes impact your business and tax situation? All right. And then finally, what about distributing profits to owners? From a business perspective, C corporations can distribute dividends. Other types of business entities can also distribute earnings to their owners. And when we get into chapter 15, we'll talk about the different impacts of those distributions to owners. All right, so obviously businesses care about taxes. Who else cares about taxes? Well, politicians care about taxes, right? And why do politicians care about taxes? Well, first of all, politicians should be wanting to better society and better the government. And so the government obviously needs tax revenue in order to do all of those constitutional things, provide for the common defense, promote the general welfare, right? That whole song from Schoolhouse Rock is based on the ability to provide services to a society. And how do we do that? We do that with tax revenue, okay? Obviously, there are lots of opinions on what should be taxed, how those tax dollars should be spent, but at the end of the day, the goal is to provide for society. All right, so politicians absolutely care about taxes. And then from a more selfish perspective, politicians care about taxes because voters care about taxes, right? And so there is that angle as well. Who else cares about taxes? Well, you and I, individuals, care about taxes. And why do we care about taxes? Well, because again, they are a cash expense, and they are a very large cash expense, right? And how taxes are implemented can certainly impact decisions that we would make. Do you own a home? Do you rent a home? When do you retire? How do you try to finance your retirement? All of those types of things make taxes a huge topic of interest for businesses, politicians, and individuals. Okay, so with all of that having been said, now let's talk about some different types of payments and discuss whether or not they would qualify as a tax. All right, so we've got all of these examples of payments. All right, so what about the dollars you spend to get your driver's license? Is that a tax or is that a fee? Well, hopefully I have paused long enough. That is in fact a fee. That is not a tax. And why is that not a tax? Well, that is not a tax because do you pay that to a government agency? Yes, you absolutely do. Is it a required payment? Yeah, if you want to get a driver's license, you're going to have to shell out a couple of dollars to get it. But do you get a specific benefit from the government related to that payment? And the answer is yes. In order to have a legal driver's license, you have to pay that license fee. So that makes it a fee and not a tax. Okay? What about a payment required by the government for a home appraisal? Well, that payment would not be a tax either. And the reason for that is, again, you get a specific benefit out of that. Okay, so your specific benefit would be that you have an official appraised value of your home, and you can use that appraisal for whatever purpose you would need. Okay. The next one is a payment for a hotel for, so a use tax, essentially, or I shouldn't have said tax, a use of 1% of the bill to pay for city projects. So I kind of gave that one away. That one is in fact a tax. And why is that a tax? Well, it is a required payment, and it is by a government agency because you're paying essentially a tax for the use of that hotel. And it's designed to pay for city projects, so not a particular project. And you don't get any specific benefit out of those city projects. The city maybe gets better sidewalks or a larger or better infrastructure, but it's an indirect benefit as opposed to a specific benefit. Okay. What about payment for rental car use of 3% of the bill to pay for roads? Again, that would be considered a tax because it is a required payment. by a government agency, but it is not a specific benefit to you. It is a general benefit to people who were not using rental cars but still get to drive on better roads. Okay, so hopefully that helps explain the difference between a tax and a fee. All right, so the next question then is always, once we figured out that something is a tax, how do you calculate the amount of tax? Okay, and so this is a very basic tax formula, but it's one that's gonna follow us really through the rest of your life. This is how you calculate a tax. All right, so your tax is going to be equal to the tax base times the tax rate. So let's talk about each of those things. So let's talk about the tax rate first. Okay, so usually it's expressed as a percentage. And this is really usually the simplest part of the calculation, right? So if we're talking about a sales tax, it may be 7% in your state or 5.25%. And so whatever you purchase at the Walmart, as you roll through with your, with your socks and your car battery, and whatever else you're buying at the Walmart, your shampoo, everything gets this one tax rate applied to it, right? And so that is your tax rate. The tax base, all right, is what is actually taxed. It's the amount that's actually taxed, all right? So, and that is usually expressed in monetary terms. So, usually expressed as, we'll say, in this case, as a dollar amount. So, for example, if I pick up a package of socks at the Walmart and those socks say $10 on the sales tag, what is that? That's my tax base. That $10 is my tax base. Whatever my sales tax rate is my tax rate. And then the amount of tax that I pay is just my tax base times my tax rate. Okay? Now, you may have heard, especially this past year with all of the news coverage of the election and different tax policy proposals, there are different ways to measure different tax rates, okay? And so you're going to hear different names thrown out. So we've got a marginal tax rate, an average tax rate, an effective tax rate, okay? And so these three types of tax rates are calculated differently and tell us different information, all right? But they're each equally important in their own way. So let's look at marginal tax rate first, and I'm going to expand my slide a little bit so I have more room to write, okay? So marginal tax rate. Your marginal tax rate is the tax rate that applies to the next increment of taxable income, all right? So tax rate applied to the next dollar of income, all right? And when would the marginal tax rate be used? So one of my biggest frustrations when I hear people talk about tax rates is they will try to compare different entities based on their tax rate, and sometimes they will use marginal tax rates, for example, to compare different entities, and this is problematic. So a marginal tax rate is a great comparison for the same entity across time, right? So if your marginal tax rate is increasing, that can mean one of two things, right? As an individual, if our marginal tax rate increases, that can mean, A, we're making more money, right? And we've moved to a higher tax bracket. So that's a way to compare the same entity over different points in time, all right? The other thing that an increase in marginal tax rate could mean is it could mean that tax policy has changed, right? For whatever reason, Congress has changed the tax brackets, and now you're making the same amount of income, but this next year, your marginal tax rate has increased. Okay, again, you're comparing the same entity, in this situation, you, to yourself at a different point in time. So that's when marginal tax rates are particularly useful. Okay. Next, let's talk about average tax rates. Okay. So average tax rates are the taxpayer's average level of taxation on each dollar of taxable income. So let's hold on for just a minute, and I will write down a formula to help you calculate average tax. So the formula to calculate your average tax is your total tax liability over your taxable income. Okay? So that is how you would calculate your average tax. So what that tells you is just your average amount of taxation that you're subjected to per dollar of taxable income. Okay? Now, the third measure for tax rates that you're going to see a lot of times is effective tax rate. All right, and the news likes to talk about effective tax rates a lot. Okay, and so how does the effective tax rate help us? Well, the effective tax rate lets us know what our amount of taxation is on each dollar of total income, both taxable and untaxable. Okay, so it's still tax liability as the numerator, but then the denominator, instead of being taxable income, is total income. Okay? And so what is effective tax rate useful for? Well, effective tax rate is really useful for comparing entities. So it's a great way to tell us how entities are doing from a tax planning perspective, or what the actual effect of tax policy is on an entity. So if my effective tax rate is 10% and somebody else's effective tax rate is 15%, we could look at that and compare different entities at the same period of time. Okay, so effective tax rate versus marginal tax rate versus average tax rate, they're all fantastic measures of the impact of taxation, but they tell us fundamentally different things. And I think that is a very important thing to understand. Now, we're going to do lots of problems where you have to calculate marginal tax rate, average tax rate, and effective tax rate. All right, so now let's talk about tax rate structures. Okay, so you're going to hear these things talked about too. So a flat tax is something that you hear, again, talked about routinely in the news, right? So a proportional tax rate schedule, or a flat tax, means that it's a constant rate. Regardless of what the tax base does, the tax rate is the same. So an example of this would be sales tax, right? Sales tax rate is one rate across the board, okay? A progressive tax rate schedule means that as the tax base gets larger, your tax rate gets larger. So an example of that is income taxes, okay? So base goes up, rate goes up, all right? Sales tax means base goes up, rate stays the same, okay? Now, what about a regressive tax rate schedule? A regressive tax rate schedule means that as your base goes up, the rate would go down, all right? And in the U.S. tax code, there isn't a tax rate schedule that is purely regressive. However, we have the Social Security tax system that is effectively a regressive tax rate. And the reason that it's effectively a regressive tax rate is because it caps out, all right? So wages above a certain level are no longer subject to Social Security tax. So this is a great slide because it gives you a visual representation of what's going on, right? Regressive, as your tax base increases, your tax rate decreases, right? Progressive, exactly the opposite. And then you can see proportional is just a straight line, right? Because your tax rate is always the same, whatever tax rate you choose, okay? Now, what we have next are a ton of different types of taxes, okay? Most of these you already know something about, so we'll just talk a little bit about each one, all right? Income taxes, obviously you know what those are. Those are levied at the federal and the state level. Also, some localities have income taxes. There are also employment and unemployment taxes. So this is your Social Security tax and your Medicare tax, all right? Excise taxes. Excise taxes are levied on the quantity as opposed to the dollar amount, all right? And so what are these levied on? Well, gasoline, liquor, cigarettes, okay? Transfer taxes. What are examples of transfer taxes? Gift and estate taxes, all right? Now, what types of taxes are there at the state and local level? Well, sales and use tax, okay? So everyone's probably familiar with what a sales tax is, right? You roll through the Walmart, you buy your socks, you have to pay sales tax, okay? What about a use tax, okay? A use tax is kind of the counterpart to a sales tax. So I live in Illinois, all right? So say I drive to Missouri and I buy a car in Missouri, okay? Well, since I am not a resident of Missouri, I don't pay Missouri sales tax. I'm a resident of Illinois. I have to pay Illinois taxes based on my purchases. But now because I've purchased that car outside of the state of Illinois, it's not a sales tax, it is a use tax, okay? So you hear a lot about these from internet sales, okay? And we can talk more about these if we need to. Property taxes, right, are levied on real property, houses, land. They're also levied on automobiles in certain states, okay? Income taxes and excise taxes, we've already talked about, all right? Implicit taxes are an interesting entity, okay? So in all of these other situations, all of these previous taxes that we talked about, okay, these are all examples of, all right, explicit taxes, all right? And explicit taxes have a stated or known rate, okay? So your income tax, you know what your income tax rate is. It's got a stated rate. You can look at schedules and find it. You know what that is, all right? Implicit taxes are different. Implicit taxes do not have a stated rate, okay? Implicit taxes are essentially an indirect tax. So essentially what an implicit tax is a reduction in your rate of return because of a tax advantage situation. Oops. Okay, and I'll give you an example. An example is the difference between two investments. Okay, so say you could invest in a taxable bond versus a non-taxable bond. Okay, typically the taxable bond is going to have a higher rate of return. Okay, now what's the implicit tax? The implicit tax is the difference in those rates of return. Okay, and this is going to be a big part of our discussion in Chapter 3 when we talk about tax planning. All right? And now let's talk about some ways to evaluate tax systems. Okay? So obviously taxes are an economic issue, but they're also a political issue. And as a result, we find that having a conversation about what should be taxed, how it should be taxed, how taxes are allocated, all of those kinds of things are very politically charged conversations. So many, many years ago, Adam Smith wrote, very famously wrote The Wealth of Nations, and he came up with kind of 5 tax canons, a system by which to evaluate different tax systems, okay? And so he came up with these kind of categories by which we could talk about tax systems and the relative worth of tax systems in a non-political way, all right? So let's talk about what each of these things means, okay? So sufficiency, all right? Essentially, sufficiency is saying, does the tax system generate enough revenue to provide the society with what it needs, all right? And there are several forecasting issues that governments try to use. They try to use either a static or dynamic forecasting, and we'll talk about a couple of those. You're going to see the income effect and the substitution effect mentioned in homework problems. So be sure to ask me about those and we can talk about those further, okay? Equity. Equity relates to how should the tax burden be distributed across taxpayers. And Adam Smith talks about vertical equity versus horizontal equity, okay? So vertical equity means taxpayers with different situations should be taxed differently. So someone who makes $20,000 a year should not be taxed the same as someone who makes $320,000 a year, okay? That's vertical equity. Horizontal equity says similarly situated taxpayers should be taxed similarly. So folks who make $20,000 a year should be taxed the same as other folks who make $20,000 a year, okay? Certainty. Certainty really has two angles. It has a taxpayer angle and a government angle. From a taxpayer perspective, it means the tax system should be stable enough that taxpayers can predict and have some certainty regarding how much tax they're going to owe, all right? From a government perspective, again, the tax system should be stable enough that the government can predict how much revenue they're going to generate so that they can take care of the population, okay? Convenience. The tax system should be designed so that it's not too much of a hardship on the taxpayers to comply with the tax laws, okay? And then economy talks about administrative costs, all right? So does the system cost more to implement than it generates, all right? Now, we can discuss the finer points of these and whether or not we succeed or fail in the U.S. based on these categories, right? So we could look at certainty and say, okay, is our tax system stable enough that we can do some tax planning, that taxpayers can reasonably calculate what they're going to owe in taxes? And we could say, yeah, overall, pretty much, right? We can plan. We've got a pretty solid, and by solid, I mean pretty stable. It doesn't change a tremendous amount over the course of a couple of years if you look at our history. But we could look at time periods where that wasn't exactly the case. So the Tax Cuts and Jobs Act from 2016 to 2017, there were some big changes that came into play, and some of them were unexpected just because of the rate at which the Tax Cuts and Jobs Act was put into effect. Okay, so you can argue a lot of these both ways. All right. For example, convenience. Right. The tax system should be designed so that it can be collected without undue hardship to the taxpayer. All right. Well, are our taxes convenient? Well, from a withholding perspective, if you're the employee, right, your employer withholds taxes, and so that's super easy, right? But it could be argued that the tax return filing process, although all of the forms are accessible and you can certainly file electronically or file via paper method and mail it in, those things aren't necessarily hard to get your hands on. The comprehension of filing your taxes is sometimes quite challenging, right? But again, that depends on your perspective. From my perspective, filing your taxes is absolutely convenient. I do it online. I sit in my house and eat nachos and do my taxes on a Friday night. No big whoop. But arguably, I'm coming at it from a very different perspective than most of the taxpayers, right? So when we evaluate different tax systems, we can at least take some of the politics out of the discussion if we think about the effectiveness of a tax system in terms of these characteristics and discuss them that way. All right, so that is it for Chapter 1. Look for practice problems and don't forget about that tax rate schedule video because that will provide some guidance on how to actually use the tax rate schedules. All right, thanks guys.